So, Ed, in the near term, you like stocks over bonds, but I got to ask you, I mean, I'm looking at the bond market right now. You look at a 3-month yield over 4%. You look at a 1-year yield over 4%. Why not lock in that yield and just kind of let some of this volatility as we see pauses on tariffs expire and some other issues in the economy work itself out, especially after a huge 20% run up from the April lows?
Well, to clarify, our overall allocation right now is neutral on stocks versus bonds. The rationale there is that the worst is taken off the table with the pause, and the markets have basically dictated to the administration, what that if they were to follow through with some more onerous tariffs, that there would likely be a recession. But where we're left off from here is an economy that's likely to grow a little bit slower than it would have otherwise, and inflation a little bit higher. So it really needs to kind of take a wait and see attitude. But over the short term, the momentum is really with stocks, with some of the technical readings that we've seen over the past few weeks, with a kind of breadth of the market where percentage of stocks above moving averages, advancing volume, all these things that you classically see off of a low were triggered over the last few weeks. So that would allow maybe the rally in equities to continue, into the summer months before maybe the economic impact of what will still be higher tariffs, flows through into the economy.
So as we're looking at the stock market right now, you see you like growth stocks right now. When we're talking about growth stocks, you're talking the Mag 7. We were just talking about it. Mag 7 on pace for its best month ever, at least since the ETF started about 2 years ago. But down for the week. Or are there other areas of the market that you like when we're talking about growth?
Well, so I think it could be interesting to see if there's other areas besides the Mag 7 that can benefit from the developing AI story. So far, it's just been that handful of stocks, and there's going to be others that are going to be able to latch on to that theme. Now, big picture, what happens as the economy slows, but you don't go into a recession, and what you'll probably see is earnings growth moderate. That was probably baked into the cards before the tariff news came into being, just because some of the best growing stocks of the last couple of years aren't going to repeat those great growth rates for 3 years in a row. And so when growth is scarce, like any other commodity, investors are going to pay a premium for those companies that will pay for that growth. And almost by definition, those are growth stocks. And so in this slow but positive growth environment, that's the style that you want to focus on.
All right. You also say the potential Medicare cuts could have a big impact on certain parts of the market, specifically the retail sector. So what areas of the retail sector do you see benefiting from potential Medicaid cuts? Which parts do you see hurt?
So if you look at where the priorities have been, and this is just in the House bill, we'll see where the final bill ends up. But if you're cutting Medicaid, that will probably hurt low-end retailers, and there are tax benefits, particularly with the extension of the SALT tax deduction to $40,000. That's going to help upper middle class spenders. So that's more of a trading up versus trading down high-end retailers over low-end retailers. So that's, I think, when in the retail space where you can focus. There's lots of other things to consider with which companies are going to be able to navigate tariffs best. But if you want to look at just that spending bill, it's a pretty clear pivot towards high-end consumer.